Welcome, everybody. I just want to, if you're here for AWA Insurance 101 and Bonding 101, right? Thanks for making the trip to Egan. We're really excited that the Builders Group has hosted us here today. Thanks, Emily, for coordinating everything. Builders Group has been a member for just over a year, and their education foundation matched our scholarships last year, and so it's becoming a really great partnership. So really excited to have them. I sat in this room I started in 2008. I want to say I sat in this room in 2009, 10 at the latest. The building's changed. We sat there facing the same way. Mary Kay over there sat and did an Insurance 101 presentation. You talk to anyone that was here at that time, and they will still say the same thing I do. The most impactful piece was if you're signing contracts and you're not checking your insurance, I can tell you I can go to your drawer, pull out your contracts, but you're not insured for this. Everyone in the room still resonates with that. So I'm sure that you're going to have those same wonderful tidbits from our presenters today, which are also with Homes Murphy. Mary is with Homes Murphy, used to be Constructor. I will let them kind of introduce themselves. So that's not a problem. And then I do, so we have Jake Schmitz here with Homes Murphy, and we have Glenn Miran with Homes Murphy, and our first male board member since about 1998, I want to say. So, Gentleman secretary just started a day. Gentlemen, take it away.
I got an intro. Thank you, Barb. Yeah, like Barb said, Homes Murphy Construction, formerly CSDZ. We're a 104-year-old insurance and bonding agency in Minneapolis, and we are focused solely in construction. So, with that, I will get right into it here. And what Barb said is so important. I just want to touch on this. The contracts that you guys are signing, I mean, insurance obviously goes hand in hand with that. And if you're signing something in a contract and don't have the coverage, it's on you guys. You know, we only know as much as what you tell us to some extent. So just want to make importance of that. On the insurance side, I'm going to cover some of the basics, talk about policy structure a little bit, program structure, a couple different types of coverages that are generally seen and that we'd recommend, suggest you have and need. I'll go over certificates of insurance, and Nate is going to take the bonding. So we're going to start off with a few definitions. The long-winded definition of insurance here, a contractual relationship when one party, insurer, for a consideration, I believe that is cut off, premium, agrees to reimburse another, the insured, for a loss to a specific subject, the risk, construction, everyone here, caused by a designated contingency, hazard, or peril. Simpler terms, protection from financial loss is how I like to think of it shortly. Next, primary insurance. This is the policy that responds first to a loss. Umbrella is the coverage that applies when the primary insurance has been exhausted. And we're going to go into depth a little bit more there. So first party coverage is the insurance applying to the insured's own property or person. So that would be you. Third party coverage is insurance applying to the risk of losses to third parties. General liability, we're going to go in depth in that portion as well. Exclusion is a policy provision referring to a hazard or peril circumstance of property that is not covered by the policy. There are many known exclusions. I mean, water, mold, some of these pop up. Some of them you can remove, some of them you can't. We'll go into that. And subrogation essentially is the insurance carrier, your insurance carrier, going back to whoever is responsible to obtain the financial liability there. So moving on, this is you, Jake.
Yes, now heading into kind of the policy structure and how it's actually set up. I'm going to go through a couple of these specifically, but starting with exclusions, kind of what Glenn mentioned, it's what is not included in your policy, what's not covered. So if there's one portion of your insurance policy that you spend time looking at, I recommend it be this. You should know what is not covered, because when you are trying to have a claim paid, the first thing the insurance adjuster is going to do is they're going to be looking at your exclusions. We also want to make sure that you know who is an insured on your policy. Basically, this is who is going to be paid in the event of a loss. You want to make sure that you have the right entity, right people listed on this, and that it's spelled out perfectly. And then dropping down to coverage endorsements, these are enhancements and restrictions to your policy, things like blanket additional insurance, waiver of subrogation, and many other things like that. You want to know what your coverage endorsements are, and you really need to know what is excluded on your policy. If you have specific questions about what exclusions you have on your policy, talk to your agent. That's what we're here for. We're able to look at your policies and help get you the answers that you need. So to kind of put the program structure together, we have this nice diagram that kind of goes over all the different lines of coverage. Most of these are lines of coverage that you have. Now, Glenn and I are both going to explain how this works. So I want to point your attention here to the one sitting underneath the excess liability and umbrella. These are your liability lines of coverage. So your general liability, your auto liability, and your employer's liability. So these are what are known as third-party coverages. So it's when you are inflicting damage on someone or someone's policy. Those are those three lines of coverage. And now your umbrella, which is the larger limit value that sits on top of those three lines of coverage, basically enhances your coverages and your limits if you were to have a claim for an automobile accident, your employer liability, or perhaps your general liability. Okay, great. I want to make it clear that the umbrella does not protect against your own losses. So it won't cover your equipment breakdowns or anything that you're doing that you might mess up when it comes to your work. It's only for work, or it's only for things when you hurt someone else, when you damage someone else's property. Next to that is the workers' comp. Everyone should be pretty familiar with this. We'll get a little bit more in depth with it in just a minute, but it's a statutory coverage, meaning it's required by the state. And you'll see the arrow kind of pointing up. That means there is no true limit to this. So whatever the damages are, they're going to be paid. Then Glenn, can you talk a little bit about those last three?
Yeah, executive risk, professional pollution, contractors equipment, executive risk, you might have seen PLI or employers practices liability. That's kind of the harassment. It's fires and hires, issues with that, professional and pollution. Some of you may be required for this. Some of you have maybe seen or negotiated out of it. Really depends on your scope of work there. And we have various depending on who you're working with, the size of project, things like that. The property and contractors equipment is also standalone and various, as everybody has their own operation and different equipment for their needs.
And going a little bit further into the workers' compensation, again, it's required by law to carry this line of coverage. So if you are a business owner with even one part-time employee, you're going to have some sort of workers' compensation policy. It's important to know that it's here to protect the workers. If you have any sort of injury or thing that would trigger a claim for your workers' compensation, it's really important that it's reported as a claim and not handled kind of under the table by the business, because the risk that you take on as a business owner is if you are paying a claim that is specifically an injury out of pocket, rather than going through your workers' compensation insurance. Say someone cuts their hand and they need stitches, and then you don't want to report it because you're afraid your experience amount is going to go up or your rates might go up. Well, the danger that you face is that if they need say that their hand gets infected after they go into the stitches, you are now on the hook and liable for all future payments, for missed time, for future hospital bills. Your policy will no longer respond once you have made payments rather than going through the actual policy. So I think that's a really, really important piece to understand is when in doubt, report it as a claim and it'll get sorted out from that. Employer's liability coverage, we saw this was underneath the umbrella that on the previous slide. The employer's liability protects you, the employer, from things such as being sued for not keeping a safe workplace or not keeping equipment up to date or up to code, where you could face penalties being sued by an employee who was hurt. That's where the employee liability comes in. Work liability.
And I did just want to, Jake had mentioned that employer's liability piece. That is specifically to you, the business owner, or those making those decisions there. Work compensation continued. As Jake said earlier, workers' compensation is statutory. So no matter the significance of the loss, it's going to be paid through workers' compensation. Other states' coverage, if you are working outside of your domiciled location, your broker needs to know that. Different states have different work comp laws, so that's something we need to communicate with the carrier. Extraterrestrial coverage essentially means that employees working outside in a different state get the opportunity to choose where to file their claim. So if you're working in North Dakota and you're domiciled in Minnesota, the employee can choose to file that claim through North Dakota if they wish. Monopolistic states are a few odd states. Some of them are North Dakota, Ohio, Washington, Wyoming. Essentially, they have their own program that you go through that's not facilitated by us. And your broker also needs to know of these states if you're working in any of these. And a couple of typical employer's liability limits, just wanted to show those below. Okay, work comp continued. So stopgap endorsement, that is the endorsement that if you are working out of state, like in a monopolistic state like North Dakota, where your coverage doesn't apply, stopgap ensures that the employer's liability piece is still continued from your policy. So you do need that if you're working in a monopolistic state. Blanket waiver of subrogation endorsement. You all have probably seen this at some point. It's pretty standard, but in your contracts, you'll be asked for this where you're giving up your carrier's right to pursue financially going after them. And a blanket is just the term where you're not having to put the contractor or the prime's name on every single one of those. USL&H and maritime coverage endorsements, these are both related to water. I'm not sure how many of you are doing work on waterways, but the water kind of has its own law in a way. You know, it goes from state to state, so it has a little bit of its own control there. Make sure that you have these endorsements if you are working on or near water.
Next, we'll talk about your automobile insurance. There's really two branches of it. There's the liability piece and the physical damage piece. As mentioned before, the liability piece is underneath your umbrella. So again, if you cause damage to someone else's property or you injure someone else outside of your company, that's where the auto liability kicks in. And the auto claims are the type of claim you're most likely to face as a business owner, and the thing you probably report most often are these auto claims. And then there's the physical damage, which is the damage that your vehicle like. So if we look at this picture here, we can see that dump truck there's going to be the physical damage to the dump truck, but then the liability would be for both of those damaged cars and anyone injured that was inside of those vehicles. If you can also see maybe some oil or diesel leaking onto the road, that would be more the pollution component. We'll get a little bit more into pollution later, but that can be a pretty serious risk to you as well.
I'm going to go over some of the typical coverages that you see. These are all included in some fashion, but the auto limit is typically under a combined single limit, 1 million. Medical payments is for the medical expenses caused by an auto, regardless of fault. Uninsured and underinsured, this is standard under each policy you'll have, but the section I wanted to kind of focus in more are the physical damage, comp and collision. Most of you are probably very familiar with that, either in your business or in your personal lines coverage. Comprehensive are sometimes the carrier refers it to like an acts of God coverage. Hail, hitting a deer is actually kind of a tricky one. If it's roadkill or if it's an actual deer hit, there's actually kind of a line there that's an ongoing thing. Collision is your vehicle hitting another vehicle or another object, sometimes maybe a stationary object, guardrail, etc.
Continuing off of that, there are a number of things that really can modify your automobile policies. The one I want to draw your attention to right now would be the waiver of subrogation. That's when the insured waives their right to seek recovery from another party. And it's basically kind of acting in good faith. I'll take care of me with my insurer, you take care of you. And that's how that works for the most part. But then there's things such as primary non-contributory language, which means that your insurance is going to be the one that's going to be paying first before you were to look to collect from others, things of that nature.
Continuing with GL, this is insurance protecting commercial insureds from third-party liability exposures, as we talked about. Just as it says, it's general liability. I mean, it's third party. It's a lot of claims fall under this piece, actually. Here are some of the traditional limits that you'll see broken out. You've probably seen these on certificates or on your policy. And then examples of this, I thought this was a great one. Second from the bottom, claimant alleges respiratory issues after inhaling wood dust from grinding machines nearby. So that would fall under general liability, catching that from someone else, being injured or harmed from your doing.
Continuing on the general liability, these few things that we have up here are kind of what Barb was talking about before, about making sure you understand what's in your contract. Oftentimes your contracts will be calling to have a certain per project aggregate, additional insured coverages, blanket waiver of subrogation, and the primary non-contributory language. When you are signing that contract, you are signing to the fact that you have these requirements in place. It is very important that you actually do. You can face pretty severe penalties, as some of you may know, when you are signing contracts when you don't have everything required in the contract. So the blanket waiver of subrogation, again, that's going to be a really important one, but we won't spend too much time talking about each individual one, but please read through your contracts. If you have questions about your contracts, again, hit a gun up, hit myself up, or your current insurance broker, because they're the ones here to really help you with these things and make sure that you're protected. Moving on to the umbrella excess, we've spent some time talking about that. So I want to go a little bit into the current umbrella market and the questions you may have on that. So right now, the umbrella market, prices have gone up on umbrellas while limits tend to have gone down. This is because we're experiencing, or the carriers really are experiencing more claims, umbrella claims, than they have in the past. So this means that maybe, especially in the auto industry, so the auto liability limits are being fully used, and then we have to go to the umbrella to pay out the rest of these claims. So that's why you're seeing increases when it comes to the umbrella, but it's mostly because we're not being safe enough on the roads. And when you do get into the umbrella, oftentimes in future years, your carrier will either non-renew you, or you'll be facing very steep increases in your premiums for the umbrella, for the automobile lines of coverage. A quick small difference between umbrella and excess liability. Excess liability is that the umbrella potentially broadens some of your coverage, where the excess liability only extends the coverage you currently have for your general liability, your employer's liability, automobile liability. So umbrella, I would say, is most common, and that's usually what we try to secure for our clients.
And Jake mentioned, I just wanted to add, difficulties with getting higher umbrella limits. Sometimes we're given the option to stack excess liability over that. So that is another avenue if needed. I just wanted to state here that coverage does not normally apply excess of the below policies. Uninsured, underinsured, motorist coverage, med payments, personal injury protection, PIP, professional, pollution, aircraft. These are all outside of that. And I just want you to know that these are not included. Some of these have variations that you may be able to add depending on carrier. So if one of these applies to you, consider talking to your agent about going through to see if there's an exclusion within the umbrella, because it is not included. And then this page also talks about the limits of an umbrella, the whys, the size of company. I mean, you know, the ability to get more. The carriers consider that. What states you're working in. New York, California, as Jake mentioned, you know, auto accidents. I mean, these are states where claims are just higher, right? So it's harder to get higher umbrella limits for these states because they could likely be engaged. Number of autos and size of autos. So the amount of fleet you have, more liability on the road makes sense. And the net worth of the company. So as Jake mentioned, may be difficult to get higher limits. Personally, this is kind of a fear thing from an insurance side. You know, I mean, everybody fears that worst day where, God forbid, a bus is hit and, you know, there's claims just going on to multiple people within a vehicle. I mean, these things happen. And 5 million below are just some typical limits that we see. Certainly can get higher to the tens. And let's see, professional. So some of you may be required of this, some of you may not. The main thing I wanted to point to is the considerations. Are you designing? Do you have PEs on staff? Are you giving advice that is changing the outcome of what you're doing? If you say yes to these, you should consider looking at professional liability. If these don't apply, negotiate with other contract fees.
Another line of coverage would be your pollution liability insurance. Pollution liability is basically protects against the cost to clean up after some sort of contaminants may be entering a building, a roadway, waterway, what have you. Anything that damage that you caused because maybe oil or asbestos or anything like that would get into an area where it's not supposed to be. And so recently we've seen a lot of pollution liability requirements coming up with contracts. So it's important to understand and read through your contract so you know if you're being required limits of potentially 1 to 2 million or even sometimes more. This is a line of coverage we highly recommend all of our clients purchase. And you can purchase it in a few different ways. You can purchase it per project or also for the whole year like you do with your other lines of insurance. If you're looking at the per project route, if you're doing, I'd say probably more than 2 projects that require the pollution limits, it probably makes more sense to go with the whole, just looking at what's most cost effective. And on this page, we just have some examples of what a pollution liability could be. So I'll just kind of read through the second one. So a telecommunications contractor performing trenching to lay a fiber optic cable. So if they hit a sewage line, that causes sewage backup to get into some buildings, which would obviously need to be cleaned up. If you shut down those companies for a few days, so their losses do with that, well, your pollution policy would respond. And contractors' equipment. This is a first-party coverage, and this is a really important one to understand. This is where the most unpaid losses happen in our industry. And they happen because we don't know what we don't know. So if you're not reporting to your insurance agent and their team that you're buying new pieces of equipment, they are not covered. There might be some small 30 to 90-day coverages to protect against this, but oftentimes those limits are not sufficient with the equipment that most of you are buying on a regular basis. That limit could be $40,000 or $50,000. And if your piece of equipment is $200,000, you're not going to be getting that $200,000 unless it is reported immediately to your insurance carrier. So what we recommend that our insurers do is that as you're buying that piece of equipment, you're sending us an email right away. It doesn't have to be anything extravagant. Just say the type of equipment, how much it costs, that we're going to make sure it gets added to your policy that day. But again, this is where we see so many unpaid claims because the insurance carrier, they're going to look at this and say, well, is it listed in your equipment schedule? If it's not, no coverage.
And to Jake's point of this being one of the biggest places that we see unpaid claims, make sure you're comfortable with the limits that you have on there. Whether it's actual cash value or replacement costs, to be talking about what you're comfortable with as far as a figure goes in the possible depreciation of that equipment is also a conversation to be having with your agent. Certificates of insurance. We can do an entire day on this. Barb, I'd be happy to come back if you want to do another portion on this one. Very hot topic. An insurance certificate is essentially a sign of good faith for the coverage that you're providing. The reason it's very touchy is some folks that you may be working with may hold off from payment unless you have these. They're usually something that needs to be done very quickly, and they aren't binding, which is interesting. It's more so a good faith. These are the coverages we have, and that the person you're sending them to is comfortable with that. And most importantly, that they align with the contract that you just signed.
All right, hi everyone, my name is Nate Weaver. I'm also with Holmes Murphy Construction, formerly CSTZ. All I do is surety bonding. I've done it the last 13 years, 8 years as an underwriter between 2 different surety companies, and I've been on the broker side now for 6 years. So I think it's important that Holmes Murphy recognizes that the surety bonding side is its own expertise. I'm very thankful I have them to answer insurance questions. I don't have a clue. And, you know, I know a little bit, but, you know, it's so important to contractors, and some of you may not bond as much work as others. So you might think, all right, his only job is surety bonding, and you sit there and twiddle his thumbs until someone needs to bid, and you're probably right. But not really. If you need bonds for some of these government contracts, it's vital to your business. If you don't get the bond, you don't get the job. You don't get the contract, you don't get that revenue. So I'm very thankful that I work for an agency that treats it as its own specialty and not just something we make, you know, we put in the corner and wait till someone bids. So the other part of that is having that expertise, because the surety carriers and those underwriters, and I can say this because I used to be one, their default setting is to say no. It's always raining in their world. If there's ever, if it's a coin flip, they're going to say no because they're incentivized to not have losses. If they don't say yes, if they don't take that risk, and they're not risk takers by nature, I know that, they're not going to say yes. So it's my job. If it is even a 10% chance I can get it done, it's my job to get it done. So. I'm going to move quickly. I mean, the first part of this is going to be kind of the different types of bonds and how they work and why you need them. I'm going to move sort of quickly through that, just because I think for a lot of people in this room, it might be more important how you get bonds. But if you have a question, stop me, please. So the first thing, there's 2 big buckets of bonds. The one that we're going to focus on the most for this whole thing is contract bonds. So these are the bonds you need to provide on bonded contracts. Government jobs, if you're a sub and the upstream contractor is telling you, hey, we need you to get a bond this for us. These are the bonds we're talking about: bid bonds, performance bonds, payment bonds, warranty maintenance, everything else. And there's thousands of them. Commercial bonds falls into that second bucket. So these might be your state of Minnesota pressure piping license bond. I mean, I can't even think of an exact one because there's millions of them. Bail bonds are commercial bonds. We don't do those. But any, you know, wage and welfare, if you're part of a union or a fringe benefits bond, all those fall into that. But since there's so many of them and they're usually a lot smaller and a lot easier to get, it's usually a one-page app or credit score. I'm not gonna talk about those because they're easy to get. But if you have questions about those, please let me know. We're gonna focus on the contract bonds. So, the contract bonds provide assurance for owners of construction projects, lenders on construction projects, upstream contractors, and subcontractors. What's not really there, if you're buying a bond, if you're the one needing the bond, it doesn't really provide assurance for you. And that's where a lot of contractors get confused is, oh, I have an issue on this job. I got a bond on it. I'm gonna go, you know, talk to my bonding person and it'll get straightened out. The only thing you get from that bond, you're the one providing it, is the right to perform that project and make money. That's a big, you know, people just getting their first surety bond don't really understand that. Now, if you're a subcontractor on a job that's bonded, say you're a mechanical sub and it's on a school job and, you know, Mortensen Construction had to post a bond on it, you can file a payment claim on their bond if you're not getting paid. But if you're providing a bond to them, that's not, your bond that you're providing is not protected. So the main types here, bid bonds. So all the bid bond does is give you permission to bid that project. It's your bid security. So all it's guaranteeing is that if you are awarded the project, you will enter into that contract within the X number of days it gives you in the specs, and that you'll provide performance and payment bonds if required. So claims on bid bonds are extremely rare because if the surety is approving a bid bond, they're pretty much already agreeing to provide performance and payment bonds. In some states, the bid bond automatically turns into performance and payment bonds. So that's all that's guaranteeing, and a claim on that would look like, say you're the low bidder at 100 grand, you have a 10% bid bond. The most you're liable for is 10 grand on that. So that percentage of bid security is the most you're liable for if there were to be a claim on that. But again, claims on those are extremely rare because, you know, if we're providing the bid bond, 99 times out of 100, we're providing the other. So performance bond and payment bond, we use these interchangeably because they're off. I mean, 99% of the time they're coming together. So the performance bond, pretty simple, guarantees performance of the contract and all the underlying specs. I mentioned that just as kind of to reiterate what the insurance folks said, you need to read your contracts. That includes the specs, because whatever you're signing, that you're promising to build with those specs and the guarantees you're providing and the maintenance periods you're providing and everything, as soon as you sign that contract and the bond is issued, you're guaranteeing them. And if you didn't read them and you get to the end, you say, well, that's not really common in our trade, or that's not fair. We would probably agree with you, but you signed it. And once it's signed, and if you haven't, and I see stuff in the specs all the time that say, hey, you have a 20-year contractor's warranty. You installed it. And you would normally, you know, if you're a roofer, building envelope contractor, you would say, well, that's a manufacturer's warranty, but it says it's a 20-year contractor's warranty. It's a 20 years contractor's warranty. So again, not to keep harping on to read those contracts. That's a big part of what we do as well. And, you know, when we're working with our clients, we're encouraging reading them for them and looking at certain parts of their contracts for those types of things. But then the payment bond guarantees payment for all labor and material to complete the contract. And we'll get into a little bit more detail there because it doesn't go to all the way down to a sub-supplier, a supplier of a supplier, but there's a cutoff point. But in general, guarantees payment for labor and material. And then the warranty maintenance bond, the first year is included with the performance payment bond. So most of the contracts you're signing will have that common 1 year for correction period. That's included with performance payment bonds. If it gets above that, there's warranty bonds that we can provide, and there's additional charges for that. So I throw this in there because this is, again, there's an important distinction between bonds and insurance. Really the only kind of commonality is their risk transfer mechanisms. On insurance, you're transferring that risk of loss on a car accident or work comp liability or something like that. With surety bonds, it's transferring the risk of performance and payment. So, and they're both provided by insurance companies, and they're both regulated by state insurance departments, and that's about where similarities end. The premium is not, you know, I hear contractors all the time say, all I do is pay premium and I don't ever have claims, and Now my surety is, that's just for the fee of providing the bond. They don't ever, getting down here, they don't ever expect to have losses. Getting back to underwriters, they don't ever expect to have a surety loss. And so the rates aren't based on expected losses. The rates for insurance are based on, we know a certain amount of cars are gonna go out on the road in car accidents. So, that's one of the biggest difference there. And then the one that a lot of people don't realize, or I guess if you don't read the agreements you have to sign when you sign up for surety bonding, the surety, if they do pay a loss, can subrogate or go against their bonded principal, which is you, to be repaid for that loss. So that it works more like a bank loan that way. And that's, we'll get into the underwriting, but that's why we have to ask for financial statements. That's also why it's not guaranteed that you can get a bond. I mean, for the most part, I don't want to put guarantee that you can get insurance for just about anything. It's just how much they're going to charge you for it. If a surety, if you're not a good surety risk, there's, we can get some tougher stuff done. But if you're not a good surety risk, underwriters are just going to say no because they don't expect that risk loss. So the 3-party agreement, this is just kind of show you how it works. So the principal, this is going to be who you're providing the bond to. You're bidding to the city of Eagan to be the GC on a new police station. They would be the principal. You would be the obligee, the contractor that we're bonding that's doing the work. And then the surety is the one providing the bond. And they all have responsibilities to each other. But in general, the main one you're worried about is right here. And then I live somewhere in here, hopefully more on this side than this side. But yeah, so that's where it's a little different. Whereas like an insurance policy, you have you and the insurance company and then people that can pay claims under it. So that's what we say when there's a 3-party agreement. So why do you need them? The short answer is there's laws for any taxpayer funded project, whether it's federal, at the federal level, it's called the Miller Act, but it basically just says it has to be bonded. And the purpose for that is that they want to protect the taxpayer money. They don't want to be in the middle of the Viking Stadium and Morton just says, yeah, we don't want to do this job anymore, we're out, or, that's an extreme example, but they want to know that there's a third party in the background that's going to make sure that job gets done no matter what. Another important part is it acts as a pre-qualification service. So again, sureties aren't just going to provide bonds to anyone. If me, Jake, and Glenn wanted to go bid on the next high school project around here, we could. No one in their right mind is going to give us a bid bond, so our bid's going to get thrown out. So that's why these cities and towns and project owners aren't in the business of pre-qualifying subcontractors to make sure they're legit. So that's what the sureties provide. And then another important piece, and really one of the main reasons the Miller Act and the Little Miller Acts, which are the state level ones and are around, is because you can't put a lien on a high school, you can't put a lien on a bridge or a stretch of highway. So it would make those jobs unattractive if you're a contractor or a subcontractor especially, and you provide work on a job and you don't get paid, you don't have any recourse. Why would you you'd have to be really gutsy to take that risk. So that's why those laws exist, because they want to make sure that they're attracting contractors to their jobs for government jobs. Some private projects can also use bonds. It's not nearly as common. It's usually the lender requiring it because they don't want to have a construction loan on a half-built apartment building. But so yeah, it can happen on private jobs too. So just to fly through payment bonds, these are called labor material bonds. Sometimes it's always 100% of the contract amount, or always 100% of the contract amount, typically issued with a performance bond together. So I think the important thing for a lot of people in here is and this is something I preach to subcontractors, or if you're ever a downstream contractor, you have 120 days to file a payment claim. And that's for the state of Minnesota. Each state's different. The bond forms will normally say 90 days, but in the state of Minnesota, it follows the lien law. So just because it says 90 days, you want to know the state that you're working in, what their laws are. But I've had contractors call me up and say, hey, I'm a sub on this job. I want to file a bond claim. My first question is going to be, when's the last time you provided labor materials on that job? It was about 6 months ago. So you can file a claim. I can tell you how, but I can almost guarantee you that it's going to get denied because sureties adhere strictly to that. And that's something that would be something, if you're a subcontractor and you're on bonded jobs a lot, I would definitely remember that, because I mean, it's common that we don't get paid, subs don't get paid for 90, 120, 160 days. That's super common, right? Make sure you know when and if you file a claim on a bond, I guarantee you that, I shouldn't guarantee you, but it's usually gonna wake up the GC a little bit quicker, or the upstream contractor, just to try to solve that problem, because their surety is now being put on notice that, hey, there might be an issue here. It's not gonna guarantee you get paid, it's just gonna let them know, and, maybe if you think you have a valid reason to get paid, or maybe you think they might just not have the money, I would very much, really all you're doing is filing your intention. Yeah.
When does that kick in? So that at the time of your pay app, and it could be multiple to the things, or pre-project, like you're not paying your pay app and it's like, you're out, 180, but you're still on the job, or is it when you're?
From the last day that you provided labor materials, very similar to the lien laws. So it's not from when your pay app was, it would be from the last time you were on that job and provided labor materials. And I'm gonna put that with the caveat that I'm not an attorney, and that the laws are different in each state and each situation, but the general rule of thumb would be from the last day you provided labor material. These payment bonds and how they work would be very similar to lien laws. So just to get into what would be covered if say you're the prime contractor and you're the bonded principal, so you're the bonded contractor on this. This is the cutoff, this black line of who could make a payment claim and who cannot. So this is important to know, because if anyone in here is a GC, the most common claims we get are payment claims. Payment claims are probably 90% of the claims we get in the surety world. And it's usually because this sub didn't pay that supplier. Even though this contractor paid them for say it's pipe on a job, oh, we paid them that 50 grand for that pipe, and the material supplier is saying they didn't get it. They might not have gotten it, and guess who's still liable for it? So you might end up, if you're a GC there, you might end up double paying because a downstream supplier or downstream sub didn't pay who they're supposed to pay. Now, if you're a sub, you can just take this line and bump it one down. If you had to provide a bond on this project to the prime contractor, you just bump that one down, and that's kind of how, there's a cutoff on how many tiers down that the surety bond will cover, but it's important for you to know that, and that's why we feel, lien waivers are extremely important. If, you're gonna pay a subcontractor or a supplier, you wanna get a lien waiver, say, hey, we're recognizing, we're acknowledging that we got paid. So those are just all things, or you can use joint checks. It's another common practice to make sure that, you're not gonna end up double paying, because those are the most common claims. So to try to move quick, I know we're starting to run out of time here, but so performance bonds, the biggest difference here is really only one party, only the obligee on that bond. So the party that you're issuing the bond, giving the bond to, only them, they can make a claim, a performance claim on a bond. And again, performance claims are extremely rare, because most contractors, and some of you might disagree with me, and by and large, most contractors know how to build a job. Where they usually run into issues is they can't pay their bills. And that's what we see most of the time. But performance claims do happen and it's, again, these are always 100% of the contract amount, and they most often come with a payment bond. One thing I'll point out, I put in here that sureties prefer to provide the bonds once the contract is signed. There's a lot of owners that are backwards on that, and we can work through that. But in general, protect yourself, make sure the contract's signed and executed before you do the bond. Like Ramsey County, I know, is one that does backwards, Hennepin County backwards. But by and large, they'll tell you, hey, you go to your surety or your broker, hey, I need a bond for this job. You're gonna want to see the contract. So in a claim situation, a performance claim situation, there's processes and procedures that all parties have to follow. A contractor or an obligee can't just like not pay you, kick you off the job, file a claim, and it's going to get paid. The surety has an obligation to investigate the claim. See if you read a bond form, it says here's the responsibilities of the obligee, here's the responsibilities of the bonded principal, here's the responsibilities of the surety. So every party has an obligation to meet those responsibilities in order for the claim to be a valid claim. And then in the event of a claim, most often, these are the options that the surety has, and I'll just kind of make them simpler here. Work with the contractor as long as the owner's cool to get them through it. Usually that involves cash flowing them through. They just made it to a cash flow crunch, or they can't pay their bills, or maybe the job's not profitable and that's causing issues. The surety can step in, figure out what's going on, just say, hey, we'll pay for those materials to get them here. We'll pay your guys overtime to get them done, get this job done. They can take over for the contractor completed. That's probably the rarest one, because sureties really screw up a job. They don't want to do the job at all. And then I'd say, but between this one and this one, these are the most common. They'll obtain bids from other qualified contractors, assign that contractor to the owner of the project, and say, then they'll probably bond it again and say, okay, they'll get it done for you. It's often going to cost a lot more than the original contract, because they're coming into a halfway done job. And then if they want to just completely wash their hands of it and they can just determine amount they owe, they can just cut a check. That one's pretty rare. Or they can deny liability for the claim if they don't think it's a valid claim, and that happens pretty frequently. So those are their options, but in order to do a few of these things, they have what's called an indemnity agreement that you sign, get a bonding program. If you read it, it's really scary. Like the scariest. If you think construction contracts are scary, sign one of those and actually read it. In order to step in and take over a contract from you, from a contractor, if that contractor isn't cooperating, there's some pretty extreme provisions in there that allow them to basically just come in and do what they want. That's why in any claim situation, my biggest advice is just communicate, because the surety is more likely to be on your side if they kind of know what's going on. And if you're still a viable business, I mean, if the contractor's just bankrupt, they're going to step in and do what they need to do to not have to cut the checks. But if there's a claim situation and you're still a viable company and you think it's a focus claim, or there's some sort of dispute, communicate so that they know what's going on, because if they don't, they're gonna go to something more extreme solutions. So we're gonna get into the underwriting process now. This is basically how to get a bond. So this is what they look at for a surety underwriter would look at for most bond programs. Before I get into what they would need, I'm gonna add the caveat that there's a lot of what we call quick bond programs out there now. And these are a one-page app that you can fill out. They do it based on personal credit scores, and you can get bonding up to, I think the most recent, like there's programs out there now, you can get bonded up to $1 million projects based on maybe a tax return and an application. Those are nice for like quick hitter. If we just have one bond and it's coming up that we don't want to have to provide all the information we're going to talk about. It just doesn't give me as your broker, if that's the route we're going, and we do it all the time. It's a fine option, but it gives me almost zero or no leverage to negotiate on your behalf for rate, terms, program amount. I mean, there isn't a program amount. It's whatever the program is for that company. I mean, they're dictating terms to us, but as a starter program or what have you, they're good programs, but you don't have to provide all this if it's under $1 million or under 750 grand. Once we get over that, that's where a lot of this stuff kicks in, and the more of it we can show and demonstrate and provide, the more leverage I have to negotiate on your behalf. So we're going to start. So, I was learning how to be a good bond underwriter. They talk about the 3 C's, and it's kind of corny, but it's capital. So how much money you have, character. Are you a good business person that's honest and going to do what you say you're going to do? And if there's a claim, you're not just going to throw us the keys to head to Mexico. And then capacity. So do you have the capacity to perform the work that you're asking us to bond for you? So that all of these things are things that your surety underwriter, surety broker is going to ask for in order to determine how much bonding credit they can extend. So good character to cover that. Financial strength, that's the capital piece, and I can get a little bit of that later. Experience matching contract requirements. Are you a mechanical contractor and you're like, we're going to try our hand at building a bridge? Your surety's probably not going to be thrilled about that. Credit history again, then business relationships. Do you have kind of what Mary talked about earlier, those trusted advisors? Do you have a good attorney? Do you have a good bank relationship? But we have a lot of clients that bank, especially, you're a heavy equipment contractor, or you're a contractor that's growing and you need your line of credit to help cash flow things as you're going through that growth phase. That banking relationship is extremely important. And then the CPA relationship, and that's important. We'll get into that in a second. And then just kind of knowing your business plan. Do you have the necessary equipment and resources to execute the work you're asking us to bond? And then the indemnification guarantees. So I mentioned that indemnity agreement. You have to sign guaranteeing that, XYZ Construction will indemnify you if you pay a loss. So that means if you pay a loss on our behalf, we're going to pay you, we're agreeing to pay you back. And it also, for bonding programs, you're required to sign personally to personally guarantee that bonding program along with your spouse, even if they're not involved in the business, which is something a lot of people don't know going into it. And I've had a lot of hard conversations about that. But it's a routine requirement when you're starting out getting surety bonding. Can we get those personal guarantees released down the road? Absolutely. I mean, we do it for clients all the time, but you have to be really strong in those 3 C areas: the character, capital, capacity. I've been underwriter for a long time, so I forget those. You have to be really strong in those areas. You have to build a relationship with a surety in order to get that done. So I would say 95% or more of our contractors, they're signing personally and their spouse is signing personally, even if they're not involved in this. So to answer all those questions on the previous years, on the previous slide, this is what you would be asked to provide. So 3 years CPA financials. So I mentioned a good CPA is a big thing they look at. The biggest hurdle for when you're just starting out with bonding, if we're going to those levels above $1 million, above $2 million single jobs, $5 million aggregates, and then on up, is you're going to need a CPA reviewed quality statement. Now, there's 3 levels of CPA statements. There's, or I should say 4 tax returns, or like the bare minimum. CPA compiled statements, the next level up, and we can get a decent amount of bonding done with that. I mean, we can get $2-3 million jobs with a compiled statement, and then what that basically is they're taking your internal books, your QuickBooks, your whatever system you use, printing it out, maybe checking that you need it, depending on how good the firm is, checking your cash, maybe check your receivables, slapping their cover page on it, saying, yeah, we looked at it, but we're not going to really promise you that the numbers are, they're not putting an opinion on it. The review is that level, and it's like the biggest hurdle for contractors looking to grow their bonding capacity. The review is that hurdle because it's not cheap. It's going to be 20-25 grand minimum for a review. And it's just, so I try to warn people ahead of time that if that's your intent, is to get that bonding program up over $2-3 million single job and up over $5-6 million aggregate, you're going to have to get a review. And it's some people think it's ridiculous, and it's so that underwriter has a greater amount of confidence in the numbers they're seeing. And the review is footnoted, so it gets in. There's a lot more checks and balances on the numbers. Often you're providing a work in process schedule with that, a completed contract schedule, all the stuff that they underwrite off of. So that would be, if you're thinking I need to grow my bonding capacity, get more work, that and you're not getting a review. There's really good construction-oriented CPAs out, and especially in this market, that I could introduce you to that can provide that. I just want you to know ahead of time it's not going to be cheap. So that's a big one of the biggest ones. They're going to want personal financial statements again because they're getting your personal guarantee. They get a lot of this is the same stuff. If you applied for a bank loan or a mortgage, a lot of this stuff is the same stuff that they're asking for. So the rest of it, there's an application. They're going to see your work in process reports, bank documents, on down experience quality. Sometimes they'll check references. Really a lot of this is dependent on how much surety credit you're asking. So the underwriting process, without getting too, this is kind of my job to know this stuff. And this is, with a lot of my clients, I'll walk through exactly how a surety looks at their, we'll sit down with their balance sheet and I can tell you, this is exactly how they're doing it. But what the 2 main things they're going to look at are working capital and equity on your balance sheet. So your working capital is your current assets, all the money and receivables, basically you have inventories in there, and then minus your current liabilities. So everything payables, bank line, current portion of debt, everything you owe. So current assets minus current liabilities, that's your working capital. And then equity is that shareholders' equity portion at the end. It's your assets minus your liabilities, that's your equity. So they're basing those are the two numbers they're basing their underwriting off of, and they make a bunch of adjustments in there based on different things that we don't have to get into. But those adjustments can be big. It can go from, hey, we have $1 million of working capital and equity. They made their adjustments. Oh, we only have 200 grand of working capital and equity. And then to kind of skip down here, they're going to give you 10 to 20 times bonding capacity, 10 to 20 times what these numbers are. That's a very oversimplified version of all this. So if I have $1 million of working capital, $1 million of equity, they can give me $10 to $20 million of surety capacity. That's the very rudimentary explanation of it. It's my job to leverage those numbers to the 20, maybe more level, but all these other things kind of help with that. Do we have good financial ratios, profitable track record? To our jobs, if we say we're going to make 10% on that job, does it come in at 10% or maybe a little more, or do they always pay it down? These are all little things they look at that we're advising our clients on, but sorry, I'm running over here, but these are all the things they're looking at. I don't know if there's any. So one of the biggest things we're seeing right now with inflation is the single project. Like, hey, the biggest job we've ever done is $1 million, but they're, you know, this GC came to us. They're asking us to bid this $5 million job. Can we get it? And the answer is usually I don't know, I have to look. So again, it's really important to just establish it, have it ready, and know what your program is, because you know, I say if you don't know what your program, if you don't know what your limits are, then you don't have a program. The questions I typically like to ask are, what's your wildest dream project? What, you know, if it's in your backyard, you know, 10 miles from our shop, or you know, we have a pit right next to it if you're a heavy highway contractor, but what's your, you know, wildest dream? You know, I know it's a big contractor that fits us perfectly and we could do that. Those are the ones we want to make sure we're ready for ahead of time and not reacting to it later. So that would kind of go to, I'm getting ahead of myself, but so yeah, I mean, we're seeing those single projects jump up because of inflation and because, you know, the cities don't have the people to let out 10 different jobs. They're trying to combine them all into one and make it one bigger contract. So then the rates, I mean, if we're just going one of those quick bonds, one sheet credit score, it can be 3% of the contract amount. If you have a program established, the bigger the job sizes get, the bigger the bonding contracts get, the amounts, the rate is per the amounts of the contract. So if you're getting up, you know, larger jobs, you can get down under 1% on your rate, but that requires a lot of that financial information that we talked about earlier. That program, we don't do that. So this is a single job, the stuff they look at, and normally I try to make this, I'm just trying to get through this quick, and if you have questions, please let me know. You'll send in a bond request form where it describes all the stuff I have here, and then the underwriter is going to look at all of these things over here. How much backlog do you have? How does that relate to backlogs you've executed in the past? What's your experience on similar projects? Excuse me, the job duration, that's an important one. If it's a 4-year job, they're basically, if they write a bond for you, they're guaranteeing you're still gonna be around in 4 years. I don't know if I'm gonna be around in 4 years. That's a long time to look out. So the longer the time duration, the more risk they see. How many subs do you have underneath you? That's a big risk because of that payment issue we talked about, and also just the risk of another contractor going under. I mean, the more people you're relying on to get that contract done, the more people underwriter's mind, more people that can fail you. And then the terms, default language, damages. If, you know, we're doing a job at the airport, or the example, if we're doing the US Bank Stadium and we're going to miss a Vikings game because the contract's not done yet, that's going to be pretty expensive on those damages. And it was, and that's actually something the Surety Association stepped in and helped get negotiated down because it was just so onerous. But those are, again, the bonds are guaranteeing the underlying contract. So if you sign something with bad damages, your surety's guaranteeing that, and because of the indemnity agreement, you're personally guaranteeing that. So if you're signing a contract on a bonded job, it sounds crazy, but you want to think of that like, hey, I'm personally guaranteeing this contract, and so is my spouse that's at home that works for 3M, whoever. So, and then the maintenance board, these are all things that underwriters going to look at when they're evaluating a single job. So I'm going to just one slide on SDI real quick. If you're a sub, you might run into this if you're working with the Moritz, the big national construction managers, GCs. it's really to boil it down there, they take a insurance policy and it's a program that rolls along their project. But it's the reason they're asking for your financials and for your, your bond pre-qual letter, and there's more and more contractors doing this. So they're asking for all these things from you that, has anyone gone through an SDI approval process that they know? I mean, may not even know they're doing it, but they'll ask you for a bond pre-qual. They'll ask you for your financials, like, hey, shoot your financials over. How thrilling is that? But that's what they're going to ask for as a part of this process, because like I mentioned earlier, bonds are really long-term solution to a short-term problem, and these GCs on some big jobs don't have time to wait on a bond. So this product was invented to basically, they can default the sub and basically an insurance check. It's not quite that simple, but that's what that is. And sometimes this gets confused with bonding because they're feeding products. If you get enrolled in a GC's SDI program, you're not going to have to provide a bond. Sometimes when they're doing that pre-qual, they might ask for your bond pre-qualification or what have you. If you don't have it, or you don't want to give it, or you don't, if they're worried about you, they'll just ask you to bond it instead of putting you in their SDI program, because they have incentives to not have losses in those programs. Because obviously, if they could just put a defaulted contractor willy-nilly and get paid, they'd probably do it all the time. But they have they have very high deductibles on these. Their deductibles are $750,000, $1 million. The first $1 million comes out of their pocket before the SDI program pays. And then if they run a good program and they're not having claims, they get dividend checks back. So that's what those are. I don't want to harp on them too much if no one's really seen them, but there's two, but we don't have to go into that. Here's our content. I'm just going to give a few closing notes that I just wanted to make sure I hit. Just a brief, the bonding industry has been extremely profitable over the last 20 years. Even through the housing bubble burst, these sureties have been making a ton of money. In fact, they're one of the highest profit margin lines of business for most insurance companies. And like any other business, those insurance companies are like, we want more of that. That's making a ton of money for us. So every insurance company is trying to grow their surety department. We've seen a ton of new entrants into the surety marketplace, which just means there's a lot softer terms out there right now than there might have been in the past. And that's not going to, I hope it continues forever, or maybe not, because it's usually, where you want to be with somebody, if there's a harder market, that's where you want to be with a broker who knows what they're doing. But it's been a really good run for the surety market. These are like the softest terms on surety that we've ever seen. Try to do it now if you think you're going to have bond needs. Even if you don't think you're going to have bond needs, it's free. Doesn't cost anything. It's a light switch in the background. You don't have to call me saying I'm on my way to put a $12 million bid in and get bond. The other important thing is your broker, so me or whoever you work with, they are not your surety. They're supposed to be your advisor. Tell them if you're having a tough year, let them know so we can start strategizing ahead of time. If you think that perfect job is coming that you want to provide a bond for, but you don't know if you can get it, tell us ahead of time. Don't tell us 3 days before you bid it. Even if you think there's a 1% chance you might bid it. I just did this for a client. They said, we just want to throw a number at this job. It's a park job. It fits us perfectly. It's twice as big as anything we've ever done. We don't really want it, but in case we're the only bidder, we want to throw a high number at it in case we get lucky. Like, okay, we can talk, we can have that conversation. So let's talk through those things. Don't be scared to ask your broker. They're not your surety. I had a client the other day say, well, should I put my liar's hat on? I said, no, those are the hats I have. Like I don't really put that. And then know your limits. I mentioned that earlier, but know what you can bond. It's important because if you're looking at opportunities, that one's too big. They wouldn't bond us for that. Or I don't know if I can just know what they are so that you're prepared and you're looking at opportunities, because I know sometimes they come last minute. You want to know what you can do.
Thank you, Nate, Jake, Glenn, and Mary for the